Okay, we're going to finish up Chapter 6 looking at the issue of income taxes. Obviously, the entities have to pay taxes, and whether they file as one consolidated group or individual legal entities depends on whether they qualify under the IRS definition of affiliated group and if they then elect to do so. If they do not qualify or elect to file, they file individually, and the intercompany items would not be deferred, and that's all in your reading. It creates a number of deferrals and some issues in terms of when items are recognized. We're going to look at an example of when they file as a consolidated group based on the consolidated worksheet, and we're going to use exercise 5 to demonstrate that concept. So I've modified the exercise just slightly, which I'll explain as we go along, but otherwise everything is available from the textbook in regards to exercise 5, and I've modified the screen here using the templates adapted to our usage for the specific items in this example. So as the textbook explains, this is an 80% ownership. The parent paid $850,000 for that 80% ownership, which implies a value of $1,062,500. The equity at date of acquisition, as given in the problem, was $968,750, creating an excess of $93,750. Now the textbook gives that as patent. The patent amortization would be for both book and tax, and it creates then a little bit more of a complication because the tax aspect for the NCI has to be segregated. To avoid too much complexity, because we're covering so much material here, we're going to shift this to be goodwill, which will be like your homework. Goodwill is an item that can be amortized for tax purposes but not book. So therefore it's a traditional timing difference which creates a deferral, but because it's the same for both parent and sub here, we don't have to do an allocation between them into the NCI. We can just take it as a lump sum, which is why I shifted that. That's the one adjustment I made to the exercise. So with that, that's our abbreviated DDE. We're going to come down to the abbreviated income statement, and you'll notice that I have a worksheet, but we're only doing the income statement portion, not the full worksheet. And I'm taking the amounts that were given as that applicable portion of the trial balance that were given in the textbook on page 362 and just entering those. So the parent had internally generated income as shown there of $65,000. The sub had internally generated income of $10,000. And those are just going up to the IDS based on the same formats that we've used before of calculating that internally generated piece. Now remember that those income distributions are then impacted by anything that is part of the worksheet in the income statement portion. In this case, because our excess is goodwill, the only income statement impact is going to be from intercompany transactions for inventory, and they had a machine sale. So we're going to have to recognize those intercompany adjustments as part of our IDS. So if we go back to the text, we see that current year they had intercompany sales of $50,000. So we know we just take that and take that off of the consolidated worksheet so that we don't overcount, but it doesn't affect the IDSs because it's an offset between an increase and decrease. Then we also see they had a beginning inventory amount of $20,000, and for that entry, remember, we adjust for the profit factor only. So the beginning inventory item is $8,000, and that does need to come up to an IDS. Since the sub was the seller, it goes to the sub's IDS, and we'll just go ahead and put that up there right away. The other half, obviously, of the BI entry is on the portion of the worksheet we're not doing in this abbreviated example. For the ending inventory, they had $6,000 by the same profit factor. The sub being the seller, that also goes to the sub's IDS, and we see the adjustments up in the IDS up here. Now they also had an intercompany sale of a machine, And you'll notice from the facts of the situation given there that there was a gain of $5,000. This is the year of the sale, and that gain shows up on the parent's trial balance. And as you recall from Chapter 4, when it's a depreciable item, we take that gain and adjust the depreciation over its remaining life. So the adjustment here is $1,000. Now the parent being the seller, these two items belong on the IDS of the parent, and that creates our adjustment. So that should all just be review from prior chapters. You'll notice we have $76,000 of consolidated income that we've split between the parent and the sub based on their IDS and based on where those worksheet entries belong. Same calculation then for adjusted income that we did in prior chapters. The new aspect is the taxes. We simply take the taxes based on that adjusted income, not the internally generated income, but the adjusted income. Take it by the tax rate, which is given as 30% in this problem. And we do that for both parent and sub. On the sub, after we get income after taxes, we segregate that between the NCI and controlling share, just like we did in prior chapters. And you'll see that we come up with reconciling figures, just like prior chapters, that relate back to the worksheet. Only other items that we have to account for here are our worksheet entries for the tax itself and for the deferral. The tax entry comes from the IDS calculations. So you'll notice the formula there is combining the taxes that were calculated on the sub and the parent. And our deferral entry is, because we adjusted this to be goodwill, we're taking the goodwill amount divided by a life of 15 years for tax purposes times the tax rate to get our deferral. And hopefully that should help you then complete the homework for Chapter 6.